My name is Cheryl Corbett, and I'm a business partner at Tonkin Torp, and I'll be today's moderator for this webinar. Welcome to our succession planning webinar. Our hope is to provide you with practical advice for your business to prepare for succession planning or a sale. If you have questions unique to your business, we invite you to reach out to our panelists directly or the Tonkin Torp lawyers you normally work with to discuss your specific situation. Today, we'll hear from three panelists. Rob Greenman, he's the Chief Growth Officer and Partner at Vista Capital Partners. Next, Gwen Griffith, an experienced tax partner at Tonkin Torp. Last, Jim Grew, Executive Advisor, President, and expert in succession leadership with the Grew Company. Let me pause first and make a note about the format of this webinar. Please know that we are actively recording this. You do not need to sign a disclosure, and no private information of yours will be shared. Please know, however, that should you choose to participate in our Q&A session, your question may be recorded in association with your name. Feel free to submit your questions in the Q&A section of your Zoom app. I'll do my best to ask each panelist a few of the questions as they come up, but we want to be sure that we have time for the roundtable and answer all the questions the panelists have prepared. So if I don't ask your question right away, please wait for the end. We will conclude with the Q&A session and try to hit as many of them as we can. Of course, we welcome any feedback you may have about our webinar. If there are other topics you want to hear about, please tell us. We hope to be a source of information for the business community. Finally, information presented here is as of November 16th and is not intended to be legal advice. So with all of the formalities out of the way, let's get to the main program. This will be a roundtable discussion, and I will ask the panelists a few questions and then they'll answer them. So let's begin with our first question. Let's start with the sales process. What is a major mistake that you've seen a seller make in preparing to sell their business?
I have one, and it's going into the sales process underprepared by underestimating what it involves and treating it like just another tough business problem that you've been able to solve all your life.
So I'll riff off of that, Cheryl. A major mistake that I see commonly made is the violation of the #1 principle of life and succession. Know yourself. So early in the process, it's important to clarify your objectives. And with most of us, we need help doing that to broaden our perspective and then to narrow it to what you really want to do. Is this a succession to family or is it a sale? Are you interested in top dollar, or do you have other issues you'd like to address, like how to take care of employees? We often see people come in at the last minute saying, oh, by the way, I have a desire to be charitable in this, and I'd like to donate some of my stock to a charity. Well, last minute is too late. And I think Rob has some experience with that. Is that right, Rob?
Yeah, no, that's for sure, Gwen. I think that's one where, as we discussed recently, that's not something that can be introduced at the 9th inning. So really having being prepared for this conversation and talking about it in advance can be super important, certainly on the charitable side, because you can do some really unique things with a private company, where you can donate it to, or a portion of it to a donor advised fund even, and that donor advised fund then on the liquidity event can get you a little more juice and be really a tax savvy way of accomplishing your charitable goals. So that's a big one. I think for me, the one thing that comes to mind is just really the idea of people getting really comfortable with understanding how these sale proceeds can fit into the overall big picture financial plan, not just the charitable piece, which may or may not exist, but really answering the question of, how can I withdraw from my portfolio each year without running out of money? And some folks might be very comfortable with that conversation, but sometimes folks don't talk about that in advance of a sale, and they really should, because they should be happening. These conversations should be happening well in advance of a sale, because you really don't want any surprises here. If you don't know how these sale proceeds fit into your long-term picture, you're kind of leaving it to chance. And I'm not sure any of us on the screen here would say that's a recommended strategy. So, really empowering these business owners to understand what we call a sustainable withdrawal rate. I think it's really important. It's a really complex process in doing that. There's a lot that goes to it. And the future investment returns, the sequence of returns that actually occur within a portfolio are really important. And there's no real one size fits all solution to any of this. And so having almost like an adept financial planner who can help you navigate that, it's a critical piece to all of this.
Well, and I'd say, I mean, when I counsel my clients on any sort of M&A transaction, getting them in the door really early and talking about what you guys have described, Jim, preparing for the sale, getting ready, getting everything in order before there's a buyer in the picture is really important. Gwen, sitting down and thinking about what are my goals? What am I trying to accomplish with this transaction? And will it meet those goals? And then lastly, I do always ask for all my clients, have you talked to your financial advisor? Because you need to know if the dollar amount you're going to receive after tax is sufficient for your long-term goals. And is your business even worth it at that moment in time when you're thinking about selling? So there's a lot of advanced planning that goes into this, and it's years before there's a buyer in the picture. So sounds like we're all on the same page about one major mistake that can happen, which is not planning far enough in advance. So now that we've talked about the major issues, let's talk about, for each of you, what is one thing that a seller should do to prepare their business for sale? And what's the one thing you would say that they should include in that preparation?
I would say gather your team. And the reason is that you need a team of experts, and we'll talk more about who they are. And you need to start working with them, hopefully 5 years before the earliest possible sale date, because you need to trust them enough so that when it gets to crunch time, you'll pay attention to their advice. And if it's somebody you've met 6 months ago, that's really hard.
Yeah.
So I would say that we need to focus on principle number 2. You remember number 1 was know yourself. Principle number 2 is know your rat's nests. We have a saying around Tonkin, there's a rat's nest in every deal. I can tell you there's a rat's nest in your financial statements and in mine and in everybody's and in the tax returns. And to continue my animal metaphor, the buyer's advisors are ferrets, and they will ferret out each of those rat's nests and beat you over the head with it. So in preparation, I always ask early for balance sheets, income statements, cash flow statements, tax returns early, 5 years worth, so we can go through and find those rat's nests and turn them into, shall we say, little cute robin's nests full of valuable eggs, or get rid of them, which is better in some ways for some. I'll give you an example of this. We were getting ready to sell for a client who had an S corporation, and I always ask to look at the S corporation election, and they didn't have it, and the IRS had it and produced it. And it was clear that the wrong people had signed the S election. Now the buyer is going to beat you over the head with that. So let's fix that in advance. And to do that, we need time. So remember the principle number 2, know your rat's nests.
That's great.
I love that. That's great, Gwen. For us, we're financial planners, so we really look ahead, of course, right? And for us, it's probably about planning what to do in retirement or what to do after selling a business, because really this takes a back seat to planning how to sell the business or what the amount is or how to fund retirement. Most people receive little to no advice, no education or training on really how to approach this next chapter. And so oftentimes what we see is folks come to us maybe after the transaction and they really haven't thought this through. And we're a big fan. We put everything in writing. When we write an investment plan, we always put everything in writing. And The great management consultant, Peter Drucker, he said, what gets measured gets managed. And so for us, we like to really develop a plan and help them kind of craft out what this next chapter is going to be. And it's important to be really thoughtful and intentional and think about what creates and gives people purpose. And, maybe some of this sounds kind of fluffy, but there's a lot of research behind it. Laura Carstensen, she's the director of the Center for Longevity at Stanford. And she's done some super cool work that really kind of demonstrates that, having people need you in an organization and an organization that you're contributing to, this is good for people. And people who are working are more likely to be physically active. There are people who are participating in the workforce. They have more social interaction. They tend to actually have more friends. And work really serves as this like social and psychological and emotional resource. So there's a lot of benefits to work. Okay. And so when we transition from owning the business or working to not working, that's a big deal. What we're not saying here is we're not saying don't sell your business and work the rest of your life. I mean, that's not the answer. We actually work in a pretty awful way. Most people work way too much and work all the time, and that's not the solution. But we do need to rethink about what work means and what it means to us. And so as we're preparing to sell the business or preparing to leave the workforce, we need a plan, and you need to have a plan for what's going to give you meaning and what's going to give you purpose in this next chapter.
Well, and I think that's a good point, because when you're planning for succession or selling a business, the owner's identity is for the most part wrapped up in the business. And who are you? Gwen, going back to your first principle, know yourself. Who are you outside of the business? I mean, that's what you're talking about, Rob. Who are you in the next chapter? What does that look like for you? And really coming to understand that. Are you going, what is your plan? So that when you get there, you're not sitting there looking around saying, now what? What do I do now?
Yeah.
And Gwen, to your point, in terms of finding the rat's nest, I mean, we, as lawyers and financial advisors, we do need a year or two to go through items and figure out what the buyer is going to find when they go through their due diligence, because anything that they find will just decrease the value of the purchase price. But if we can address it in advance, it adds value. And that's why it's sort of an investment for the long term and preparing for that sale if you get to it early enough. And then Jim, to your point, I'm gonna, follow on with just another question, because most of these businesses already have advisors. So, you say having the right advisors is important in succession planning or selling your business, but what's the difference between the usual business advisor and what's needed for a successful sales transaction?
So here's an example. Hopefully nobody here is going to have heart surgery. I'm pretty sure if you found out you did, you wouldn't ask your internal medicine doc to do the surgery. You might accept his referral to a heart surgeon. The smart guy asks the heart surgeon, here's my diagnosis. How many of these have you done? And you don't mess around with that, because if you get the wrong doc, you can die. This is close, because for most owners, there is this lot of money involved, millions. And so the question for you to ask, don't wonder, each of your advisors, and there are 5, how many business sales have you worked on personally? It doesn't count if your firm did it, you yourself. And don't be afraid to ask the question. You're the one paying their fees. So if you get people who've done it and then watch and listen carefully, and you know how to do that, you have a much better chance of getting players who will help you get through this successfully.
Yeah, probably what Jim said a couple questions ago about having the right team in place. I think that, the reality is that the stakes are suddenly a lot higher, right? Because when you're working with a financial advisor during the days before a transaction, don't get me wrong, like that, all that work is very meaningful. But in the pre-transaction days, most business owners are so involved with their companies that the lion's share of their attention is really probably focused there on their business, and rightfully so. And so it's more about, at that point, it's like, okay, I'm going to fund my retirement accounts because it's, 1, makes sense from a tax perspective, and 2, I'm kind of not putting all my eggs in one basket, and maybe I'm shuffling some excess cash flow that I'm not reinvesting back into the business into a diversified portfolio. And that's all like great stuff and super important work. But when that liquidity event, when it's shifting the wealth that was created by taking the risk and the human capital and everything over to a portfolio that is suddenly like shifting the wealth from the business over to the portfolio, the stakes are higher. So as far as what skills are necessary, I'm not sure it's a huge difference in skill set, but it's more about having the conviction, as Jim said, that you have the right team in place.
So I know you're all wondering what principle number 3 is. Remember, number 1, know yourself. Number 2, know your rat's nest. I have them, you have them. Principle number 3 is know the territory. And if you don't know the territory yourself in tax, get somebody who does. The transactions are varied. There is a wide range, but they can fall into 3 categories. A partially or fully tax-free transaction, that is the goal of everyone. There might be a way to use, qualified business stock or something like that to get us at least partially tax-free. We might do a tax-deferred transaction, like an installment sale, like getting payments over time, or doing a tax-free reorg so that you get equity in the buyer. The other thing is that it might be a fully taxable transaction, and that might be intended. I don't know about you, but I'm betting that tax rates go one direction over the next 10 years. We've got a $2 to $3 trillion deficit.
You saying they're going down, Gwen?
I say they're not going down. They're not going down. They're going up. And we're already seeing that in the Infrastructure Act and the Build Back Better Act. So you want somebody who has experience in all 3 categories, so you can say, all right, with my situation, here's the kind of transaction that I am hoping for, and this is why. And the other thing you need to know is, what are the buyers looking for in tax? And let me tell you that buyers, bless their hearts, as we say in the South, often hide in the letter of intent their true intention. They'll talk about their intention in the letter of intent in tax code, 338H10, elections, which may mean nothing to a business owner, and why should it? But it's a huge difference in tax from what someone may be expecting without such an election. So principle number 3, if you don't know what a 338H10 election is and all of that stuff of tax, get yourself a guide who does.
That's really important. I mean, for analyzing the difference in a transaction between a stock sale for tax impact versus an asset sale, and having the right advisors to tell you what the tax differential is, I mean, that makes a huge difference economically for the sale proceeds, right? And so having somebody who understands that, especially the 338H10 election, which if you don't and you do that kind of a transaction, you will be very sorry at the end of the day to find out what your taxes actually are in a transaction, have a lot less proceeds than you might think. So definitely having a specialist, I know it's self-serving as an M&A lawyer myself, that having an attorney who has the years of experience to review that transaction document, it is not the same as a general business contract or a commercial contract. There are tricks and traps in the various clauses that seem so simple when you read them, but they actually have real meaning legally and the impact of the transaction. So getting someone who knows how to do that kind of a deal and who's done it over and over again is really important. And there is a place for the usual business advisors in a transaction, because I know we work with the general counsel, outside counsel. They have the history of the business. They can help identify the rat's nests that they know about and help us with the history and answering questions and diligence from the buyer who's asking about all the things that have happened. So there's definitely a place that we cooperate with the usual business advisors, but it's a really, just to emphasize, having specialists in the M&A space for mergers and acquisitions or succession planning is really important. So I'm going to go riff off of you, Gwen, and go to taxes. And we talked a little bit about it just now. And taxes, you know, we talked about rocket science. Taxes are rocket science, frankly, for most of us. And they're more difficult and complex every year, but they are key for a sale of a business. So you hit on it a little bit, but how is tax different for the sale of a business or succession planning than your usual operations? I think Gwen and Rob have something to say here.
Yeah.
Would you like another principle, Cheryl?
Oh, I would love it.
Okay, principle number 4.
4, yes.
Learn how to play that game called Jenga. You know that thing where you put the blocks up and then you have to pull one out and put it on the top. And if you've never played that game, do it. Or just get your child's blocks out, grandchildren's blocks out, and stack them up. Because here's what happens in operationally in tax. It just rolls along for the most part behind the veil. Your controller is doing things, your CFO is doing things, your accountant's doing things, tax returns are getting filed, taxes are getting paid, I assume, otherwise it would be a rat's nest. And that all happens in the normal course. And most business owners, they do look at their tax returns, but they don't study them. This is going to be a one-time huge amount of potentially taxable gain. And it's not just federal taxes, it's state taxes. And it's, for example, where our office is in Portland, it's Multnomah County taxes and City of Portland taxes and Metro taxes. You can see the Jenga tower being built of taxes, and those stack up pretty quickly. So what we want to do, besides structuring the transaction, is we want to make sure we can figure out how they all fit together, and can we reduce the tax rate on any taxable amount by making some moves, and we need to make those moves early, not later. So we don't want to pay the fully stacked amount. How are we going to change things structurally to make sure that we don't have a stacking problem? So that is the number one ignored problem in tax. And I would tell you that, you know, the action is in state and local taxes, because your business may have taxes. Oh, that was my dog, Jake, who wants to alert you that the Amazon guy is in the neighborhood.
And he's very passionate about taxes.
Yes, that's what I was going to say.
He is.
He's putting emphasis on this, really, this one point, Gwen.
That's right. Probably Amazon is here to deliver the tax code. So you may have done business in other states and not paid taxes in other states, you know, quite innocently. We need to do an analysis of that. And then as you begin to prepare for sale, because the buyer's going to want to know that. Same internationally. If you've been doing business internationally, well, there is an analysis to do there. So those are some of the things that are different in a sale transaction.
Gwen, can I ask a follow-up question here? Because I know I get this question quite a bit from owners about relocating for tax purposes.
Yes.
How do you address that? Because that obviously is something that can minimize tax, but talk about advanced planning there.
Yes. Oregon, bless its heart, believes that it has intergalactic jurisdiction over you. And if you're domiciled here, you remain domiciled here for the rest of the period of our galaxy, unless you take steps early, and I would want a couple of years at least, where you abandon your Oregon domicile and set up domicile somewhere else. And domicile means your place of permanent residence. So we often see this right before a sale. And I have to tell you, it doesn't work. Oregon doesn't buy it. And there are so many cases we've litigated where that is not going to fly in the tax court. So if you're going to try that, first make sure you want to live wherever it is the destination domicile. And then we need to set it up correctly.
Yeah, and that's the thing. It comes up usually right before a letter of intent's received, and it does not work.
Does not work.
It does not work. So, Rob, I think you wanted to answer the question too about the difference in tax. and
Yeah, I mean,
succession.
I think the one thing to probably just talk about here is, we have to focus on controlling what we can. And sometimes tax is one of those things that we can't control tax law, but we can control how we operate within it. And so I think that's really important. And what Gwen talked about just in terms of trying to, even when we went back earlier in the conversation, talking about internal transitions where folks are perhaps giving stock to key employees to retain them. What do you have the right folks that are appropriately structuring that and getting like 83B elections in place? All these little things about just focusing on controlling what we can, because there's so many dynamics that with a transaction that you all can chime in on what can, all the different wins that can come into play there. But so what can we focus on? Well, let's control what we can. That's what we often say in investing. For us, a lot of the tax piece is going to be more on the back end, because a lot of times for business sale transactions, there's going to be these high earning years. And then if there's a sale transaction, there could be a dip in income. And this is when you just can get very strategic and start doing things like, and this is more on the after sale side of things with Roth conversions or different strategies there. But it's taking a long-term kind of view of things. And then again, just going back to controlling what we can. I think to circle back on the charitable intent one, that is one thing at the front end that we can really do some good planning on. I think that it would pain me to have a business owner that had a large liquidity event, and then a year down the line, and they're talking to us and talking about their charitable intent and saying, yeah, we like to give, we plan on giving, 50 to 100K a year away to charity. And it's like, well, goodness gracious, we could have used some of the business sale to front load and reduce the taxable income in the year of sale. And I wish we talked about this earlier and coordinated this all with your team, because it could have just been a such more tax savvy way to accomplish all of your goals, right? And so again, planning in advance, and two, just focusing on controlling what we can.
And I know, and we, that's the purpose of this webinar, is to really get people to understand that it really is an investment. If you spend the money and the time up front to plan in advance, it saves you money down the road. It saves you money in terms of keeping the transaction value. It saves you in taxes. There's a lot of things that can be done if you put the effort in up front, right? So let's go to the next question. Where do you feel that the seller is most at risk in the sales process? Jim, you're on mute.
There.
There you go.
I have one, and of course, our housekeeper is running the vacuum cleaner, so eventually that'll stop, but you can hear me. I think the biggest risk is underestimating the power of the buyer. Think about it these two ways. Whenever you buy something, you establish the value in your own mind and then work very hard to get a little bit lower price. That's how buyers buy. Your buyer is the same, with this exception. Your buyer will have way more power, horsepower, deal power than you will, unless you get the right team and plan very early. And here's why. Virtually all buyers will be working with a bank or some kind of a lender. Lenders want to be absolutely certain that the price paid for the asset isn't too high, because they don't want to be in a position of seeing their business go bankrupt because people pay too much for it. You read about this in the paper. So they pay people who hide under the floorboards at the big four accounting firms to come in and climb through your numbers to find your rat's nest, and their goal is to get the price down. That's how they get paid, and that's how they keep their job. And you don't have anybody who does that on your team unless you select them way ahead of time. These people are ruthless. That's all they do. Here's a story, true. Company here had a letter of intent for $120 million. When the floorboard people were done, they received $80 million. True story. That's $40 million. Let me say that again. $40 million. True story. Gone. Now, maybe they wouldn't have gotten all 40, but they sure wouldn't have lost it. And that's because they went into the deal underprepared, figuring, yeah, we're good. We know how to do that. So this is not theoretical.
Wow.
So Gwen, do you have our next principle for us?
Well, the next principle really I should have given to you, Cheryl, because it's know your risk and know the time to negotiate. Because for the tax risks, there are 2 times in the negotiation process where this comes up. First, in the letter of intent, because that is when a seller has most of the power. And you're never going to have more power than you have at the letter of intent on all issues, including tax issues. So if you have learned your territory and you know what you want to achieve, then that's the place where you can negotiate that. You cannot negotiate a change later without losing value. So negotiate then. And then as what happens in a deal is the negotiation gets narrower and narrower down to the deal terms that Cheryl has to negotiate carefully. And there comes a time when we're talking about tax risk again, and the seller wants to allocate as much to the buyer and the buyer wants to allocate as much to the seller. And so we're going back and forth on that. And that is when rat's nests become part of, it's not changing the price, if you will, but what is happening is an allocation of risk means that after the sale, the seller may have obligations, tax obligations. So we want to negotiate that carefully. And we don't want to have any rat's nests come at that point. They should be all taken care of so they don't end up being a seller obligation after closing. So that's what I see as the risk area. The other thing I would say is there's some procedures that have to happen in any sale. And for example, we had one this year where we needed to get a tax clearance certificate from Utah. Now, the Utah tax people aren't answering the phone or answering emails. I don't know where they are, what they're doing, but they're not communicating with us. So it took so long to get that done that there was risk to the deal itself. So we want to think about all those things as we go.
Oh, anything right now that involves a government agency is taking longer, whether they're in person or not, or working remotely with COVID, or you have a filing, for instance, that needs to be stamped and certified, and factoring that into the timeline, Gwen, that's a real issue right now. But you're right, in terms of the tax piece, the LOI for a seller is the first stage, that getting the right advice and understanding the tax implications of what you're signing in the letter of intent. The seller should know at that point how the deal is going to be taxed. And that is the time that if there is a tax issue, that you could negotiate maybe a tax payment from the buyer to cover some of the taxes that the seller is going to incur, because that's the main leverage at that point. So getting that risk taken care of upfront, I think that is a good one.
Plus, that's the time when everybody loves each other the most.
Yeah, the honeymoon phase, right?
Yes.
Yeah.
And as we say around the shop, read your LOI, your letter of intent, like a love letter. Every phrase has meaning in a love letter.
Well, and understanding the meaning of every phrase is critical, because it's not necessarily the obvious meaning when you read it. And that's, circling back, that goes back to having advisors who understand what the actual language means. from a deal perspective. So let's turn to post-sale. I mean, we've hit on it a little bit and talking about some of the things the sellers don't think about regarding their liquidity situation. I mean, Rob, I think you hit on this to some point, but the primary asset may be, the business and the value that they have in the business. And then they sell the business or they have a succession plan and transfer the business. They receive all of this money and liquidity. What are the dynamics in play, when somebody gets a chunk of money like that? What should they be thinking about? What should you be discussing with them at that point?
Yeah, I think this is a topic that really doesn't get enough attention. And it really, what we're talking about is this is the price of liquidity. So Cheryl, as you said, you're shifting from really a non-liquid investment of a business to a diversified portfolio of publicly traded stocks and bonds. And that can be really tricky, really tricky to navigate from an emotional perspective, because, we have to remember that ultimately why stock prices, why they move up and down. Prices move because investors are free to trade every minute of the day, right? Right now, in the middle of this webinar, you could open up a browser and go look at what Nike's doing, or Apple or Tesla, or pick your favorite stock, right? Or anything, Bitcoin, I guess. And so in well-functioning markets, we should expect prices to move as investors are digesting and reacting to this constant stream of information. And sometimes it's conflicting, right? Sometimes we're receiving it on both ends. And so the price of this liquidity, the price is going to be volatility. And so I think one thing that's really important is to recognize that fluctuations in price, these occur with all sorts of assets. Even if they're not, regularly observable, this is occurring all the time. It occurs in real estate. It occurs in these businesses before the sale is completed. The fact that we don't see daily prices kind of streaming across a ticker tape, if you will, it basically is masking the underlying price volatility of these investments. But nonetheless, it definitely still exists. Our chief investment officer, Dougal Williams, he does a really nice job of bringing this into perspective. So remember back in the last few summers, actually, but he brought up this example of, imagine if you owned a house in one of these neighboring communities that was kind of ravaged by wildfire, right? Hundreds of thousands of acres, sadly going up in smoke, and neighborhoods evacuated, and it was a scary time. And so if you had a house in one of these neighboring communities, what price would you have fetched if you'd required an immediate 100% cash offer, right? Not 30, 60 days, no back and forth negotiation, but liquidity, right? You could expect that there would be some volatility there. And so that's what's happening when we're shifting to a portfolio of liquid assets, portfolio of stocks and bonds. Suddenly that business owner is going from something that they're masking that volatility in their business, to something that, whether they choose to or not, we can argue whether that's a good idea to or not, it's all of a sudden in their face all the time. So I think recognizing that difference is really important, and just being mindful of that and preparing for that transition, I think is a helpful step, and just helping people understand really what matters in investing and what makes investors successful versus unsuccessful.
Yeah, there's a psychology to it, basically, that
Huge.
that you're not on a daily basis aware of the volatility and the value of your business. But when you get the cash and you've invested it in something, you are very aware of the fluctuation and the panic that can you feel as a result as an owner, because you're seeing this, and this is now what you're relying on for the long term. And
it's a control thing too, right? I mean, you're going from a business owner seemingly feels very in control of this asset, which maybe they are, like they have some direct operational, the way they run it, but it's going from I feel in control to now I feel not as in control.
Rob, do you have a 12-step program for this transition?
We do. We do.
That's helpful. So I'm going to ask a broad question now that that each of you can take on, but what would you tell a business owner to do, and what should they be doing right now in anticipation of a sale or other succession plan? What would you advise them right now? Like, what should they be doing?
So Cheryl, I'll take this and offer my last principle.
Oh, this is number 6 now?
Number 6.
Okay, I'm trying to keep track.
Yes. Know your friends. I've been in this business for 40 years, which is shocking to me. And I've never seen an employment market like this one, where a person can quit their job on Tuesday morning and be employed at a higher salary with more flexibility on Tuesday afternoon. Now, I've spent a lot of time researching what the heck is going on out there. And my sense is that this does not end with the pandemic. Things have shifted dramatically. So what I would be thinking about is how to get my key employees tied to the business so that they will be in place when a buyer comes along. And there are all sorts of ways to do that. You can do stock options, you can do phantom stock plans, you can do restricted stock, you can do a bonus plan that ties key employees to the business. Those have enormous tax ramifications in and of themselves. But when we're thinking about selling in a few years, it takes on an added complexity. That is, what we do now could totally screw up the deal in the future. So we need to be clear about what our objective is, coming back to principle number 1, because what we do now with key employees will be of high interest to a buyer and have tax ramifications. Cheryl, you and I have been in deals where we had to do a terrible analysis of the golden parachute rules. And we had to get consents of 400 people because they had an interest in the business. So we want to make sure that we observe the 3 C's of employee retention. That is, they want to be in collaboration with their peers, they want to have control over their lives, and they want to be fairly compensated. We want to do a plan that works for them, but then at the same time, not screw up the deal later.
Yeah, those are 2 puzzle pieces that need to come together. And you're right, oftentimes we are in a deal and we discover what was in place, and then it creates a problem in terms of getting the deal done and having to renegotiate or open things up again. So keeping key management in place for the buyer will be important, and then making sure that those 2 puzzle pieces fit together and having the right people advise you on that. Jim or Rob?
I have one, and that's upgrade your 2 key teams. One team we've mentioned, which is your team of advisors. There are 5, by the way, and the test for you is, can you name all 5? And I will give you 1 beer if you can, not the people on the screen, the people in the audience. It's 5, it's not 3. Yes, of course, your accountant and your lawyer, there's 3 more. The other one is your management team, which we haven't talked about. The challenge is, if you are the driver and leader of the business, when you sell, you're gone, and the value of the business drops enormously without you. One way to mitigate that is to build a management team which actually runs the business day to day. That takes 3 years. It's worth it. You'll actually make more money because they'll do more things together than you can do by yourself. So those would be the 2 things. Start with your team of advisors and start building your management team.
Love it. Yeah, I would go back and just say, go ask your financial advisor to do some modeling and get really comfortable with it. Whether or not you think a sale is, coming up here soon or way down the line, or maybe it's not even in the plans to sell immediately, but cash flow from the business and seeing how it fits into your big picture and how it works in concert with everything else going on in your life. And, even looking at a deal and saying, well, if we if we fetch this price and what the tax would be and the after-tax amount, and if there's an earnout, should we plan on the earnout? Is the earnout, is us actually, our plan working? Is it dependent on the earnout? Should we look at it with the earnout and then toggle it on and off, right? And so I think a really good advisor that's working with you can, as a business owner, can look at all this in an interactive way. We've got great tools now today that can do this. And it's a good way of just making you kind of understand how it fits into your big picture and feel more comfortable with whatever that right price is.
I like that in terms of, the software and the ability to toggle things on and off. I mean, I will say from an M&A lawyer's perspective, and for those on the call, and earnout, what he's talking about is consideration and purchase price that would be paid after closing based on the performance of the business, based on some metric. And as the lawyer, I always advise the client that if there's anything contingent to be paid post-closing and based on either a promissory note or a contingency like a performance earnout, don't count on it. But it's so don't count on seeing it. But from your perspective, Rob, from financial planning, being able to turn it on or off, or say, what if I get 25% or I only get 50%? And how does this affect everything? That can be a really good input in a seller trying to decide, well, is this offer good enough? Should I accept it? Right?
Yeah.
Because
For sure.
if you're evaluating multiple offers, that's one of the factors you need to look at.
Yeah, 100%.
So another question that I'm getting right now in terms from clients is, I really need to sell my business before the year end to avoid these tax hits. What are your thoughts on that? And I will say, as the M&A lawyer, if you don't already have a transaction underway, it's unlikely to finish by December 31st. It would be
why is that? Why is that, Cheryl?
There's a lot that goes into a transaction that cannot be necessarily accomplished before the year end.
Yeah, think back to all the transactions that happened overnight in the beginning of what we now fondly refer to as the Great Recession. Talk about rat's nests found later. Oh my goodness. So it's true that the proposed tax legislation has a potential big hit for sellers of businesses, with a surtax of either 5% or 8% on amounts that you receive in a year over 10 million or 25 million, as the case may be. That's why we're asking people to think about structuring transactions with payments over time in an installment sale situation. Now, there's some downsides to that, of course, what Cheryl's just saying, but it's something to consider as you're talking about your objective. Now, a lot of the things that were in the tax bill earlier this year have somehow disappeared. So we don't need to be so afraid of taxes going forward in 2022, as long as we keep that one piece in mind.
Well, and I know I have, for Washington clients, there is the Washington capital gains tax is going into effect as well, January 1. So that one has definitely some more certainty to it in terms of what's going to happen. But again, talking to a tax planner about if there are any exceptions or what you might be able to do there to mitigate that would be important. Did anyone else want to talk about what you tell somebody if they want to try to sell before the end of this year?
One other thought, huddle with your tax advisor immediately, but already know your odds are lousy. It's 6 weeks till the end of the year. That's 4 working weeks. Take out Christmas and take out Thanksgiving because nobody works then, in spite of how they look. And the buyer will know if you're rushing. So the buyer will be happy to pay you less in order to close the deal. They can't wait. They'll be thrilled. And so an investment banker is one of the advisors, by the way, that you didn't think of. And here is a place where you absolutely need someone who is skilled in valuation, probability of sale, alternate buyers, all of which are ways for you to answer the question, is a rush sale now better than a methodical sale next year? Usually no, but if you don't have brains working with you and you sell, you're going to get less. You just are. And I'm not a lawyer, so I can just say that.
I think yeah, I like that too. I'm also not a lawyer, so I can say some things. But
The lawyers can say.
You're right.
I think one thing, the saying that comes to mind is don't let the tax tail wag the dog, right? And so I think going back again, like we just have to focus on controlling what we can. Now, if you want to restructure a deal that changes the composition of how the payout occurs, maybe there's some new risks that get introduced there. It reminds me of, the conversation that sometimes come up unrelated to business owner, but more of like a concentrated stock position. It's like, well, I don't want to sell all this because I don't want to pay the tax. And it's like, well, okay, but a tax is on a percentage of that investment and of the gain on that investment. And by the way, if that stock just goes down 10 or 20%, any difference in tax law or tax change that occurs, that's going to be completely overwhelmed by the change in the valuation of whatever you're going to sell this asset for. So I just think we have to be really careful with that. And again, going back to the conversation of to plug, running some projections and some numbers, is look at it a few different ways and just say like, well, maybe it's okay. And yes, maybe tax law does mean that the after-tax proceeds are a little bit differently, but how does this all work in the context of everything, and kind of tune out the noise and focus on controlling what we can. And maybe it still works okay and it's still the right deal. And so maybe we move forward still.
So another question that's come up is about internal succession planning. We're talking a lot about the sale of a business, and that is a succession plan, right? To sell your business to a third party. But what about transferring it to somebody internally? How do you prepare for something like that? How is that different from a traditional sale of a business?
I can do that. I have a client who has done that very successfully. The first question is, who's going to lead the business? That's ahead of tax, that's ahead of sale price, that's ahead of everything else. Because buyers or people who are going to give you money for your business will be looking at how will the business run when you leave. And so I should have added, if you don't have somebody named to run your business now, start on that, because whether you sell or not, that will increase the value of your business. Second, if you identify a person from inside, that opens up jobs. And so you have a chain of moves in people, and probably a need to improve your assessment and evaluation of people. And that chain of moves can take a couple of years before it settles. An alternative is to look around and say, there's nobody here that can run the place, but I want us to stay as an owner for 3 or 4 years. And so I will hire an outside CEO and use a headhunter to do that, and then structure a deal which pays me from the profits of the business. And that's one of the things that attorneys do. They don't talk much about it. And I could tell you that my client who has done that is enormously satisfied, as is his wife. And a side note, by the way, this is your standard entrepreneur who works 60+ hours a week for 30 years, wonderful people. And she basically said to him, look, unless you do something about this, I'm out of here because I want to see you. I love you and I don't see you enough. She's great. And they are, by the way, dear friends. And we worked through that. This was their answer. So there's another alternative.
Cheryl, I would say that in an internal succession, I have a lot more tax tools at my disposal to work within a family or a small group to get that done. And there's a lot less tax risk in those situations because we are not dealing with an outside party. We're dealing with a group of people who share a common economic interest. So there's a lot to do in those situations, coordinating with estate planning and the transition and making those things work really well together. But there's Rob, I'm going to cede principle number 1 to you. You get control what you can as principle number 1 now. In an internal succession, the group and the advisors can control a lot more than they can with an outside buyer.
That makes sense. And coordinating with the estate plan, especially in a family business, that's also critical. Rob, I didn't know, do you have something to add here?
Nope. We rely at Vista really on you all for putting together those plans, I think. So nothing to add there. Thank you.
Okay, we've just got time, I think, for one more question. What should a seller do in the next 6 months, after this session and educating them on all of these pieces to prepare it for succession planning or a sale of the business? Let's give them sort of a bite size. Here's a to-do list of what you should really be focused on in the next maybe 6 to 12 months. What would you say?
I said it, I'll say it again. Upgrade your transition team, meaning CPA, attorney, wealth advisor, investment banker, leadership expert, because it will take you months to get them. And the sooner you start, the sooner you'll have them. And upgrade your management team. You probably haven't given them much power. You can start now by saying to them, you are responsible for the budget of this business for fiscal year 2022. Let's meet in 2 weeks. I'll be interested to review your plan. That will take their breath away, but it will also get them moving.
I'll riff off of that and say, take a look at their overall compensation and figure out how you're going to tie them to you. And then, can I have 2, Cheryl, not just 1?
Sure.
Thank you.
You can have
Scrub your,
multiple.
scrub your balance sheet and your income statements, your cash flow statements, and your tax returns. Find your rat's nests.
Mhm.
Yeah, and I would close and just go back and say, start visiting with your advisors to really have a good understanding of some best case, middle of the road, and maybe a worst case scenario for some different levels of, if you were to get a price, how does it look and how it impacts your plan. And just use these interactive tools that advisors like us have today to just make you feel really comfortable, so that as you get to the seat at the table where you're trying to make these decisions with your attorney, you feel really empowered and good about whatever price you agree on and how it can play a role in whatever the future holds.
I would say if somebody were to call me right now, and say, what should I do in the next 6 months? I would have, Gwen and my team do just a cursory due diligence review of your books and records, your contracts, environmental issues, just so I could get a sense of, here are the issue spots or the hot spots that I see from a diligence perspective that we should probably focus on and clean up so you can preserve value in the transaction. So that's what I would add in terms of that. Jim, did you have something else?
Yeah, I have one other, which I'm sorry I neglected to say, which is do not sell, do not sell to your buddy in the trade association. Do not. He's your good friend. You've known him for years. You trust him. You like him. You've eaten and God knows what with him. The problem is when he or she turns into a buyer, their interests change. And I have a $1.5 million sad story of another person who did that. And there was a whole string of problems, including no investment banker to protect him. And his buddy basically left him with nothing but the right to keep the lease on the building, which he already had. Literally, that was it. So don't. And if you don't know where to find a good investment banker, call any one of us, because we know several.
That's right. Well, with that, we're going to wrap up our program for today. We hope that you found this information valuable, and we invite you to watch for additional webinars planned in the coming weeks. Thanks for joining us.